Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Well, Disney shareholders have handed CEO Bob Iger a big vote of confidence. They elected all of Disney's choices for the company's board at a proxy vote. And shareholders rejected dissident investor Nelson Peltz's bid for board seats. Peltz's ally, former Disney finance chief Jay Rasulo, was also rejected. The result is a clear-cut victory for Iger, who has fought to keep Peltz off the board since returning as CEO in 2022. Jamie Lumley, senior analyst at Third Bridge, outlines what's next for Iger after winning the vote.
One thing that I think investors will really be looking at is streaming profitability. The company's planning on finally driving profits in fiscal year 2024. This is coming after so many quarters and years of billions in losses in this segment. And we've heard Bob Iger talk about how important the streaming transition is for the business, really making sure that they're hitting their mark and achieving their goals. That's definitely priority number one as they move beyond this proxy fight.
Jamie Lumley at Third Bridge. Disney has reinstated its dividend and has announced plans to invest $60 billion in its parks and resorts over the next 10 years. It also deepened its involvement in the video game business via a $1.5 billion investment in Epic Games. Joining us now to discuss this is Bloomberg Intelligence U.S. media analyst Geetha Ranganathan. Geetha, can we say that this is a victory for both Bob Iger and Nelson Peltz? I mean, the former is obvious. The latter, Peltz, is $1 billion richer now, and he's also made a point. I guess you can say haters gonna hate. Well, this is billionaires gonna billion.
That's a perfect way to put it. And I think Nelson Peltz is definitely kind of spinning this as a win for himself, for his fund, Triad, and of course for Disney shareholders at large. I mean, the stock is definitely up 50%. And I think in many ways he's right. I mean, he is claiming that he has been the instrumental, catalyst for kind of accelerating this transformation at Disney. And I think to a large extent, that's definitely true.
Geetha, take us inside the drama of this story. I mean, this is the second time in 2 years that Peltz was trying to get board seats. And the other character that's a part of this story is Ike Perlmutter, the former chairman of Marvel Entertainment. Disney purchased Marvel for around $4 billion, and Perlmutter was able to join the leadership team. He was tossed out last year, and I'm wondering whether a part of this story had to do with a bit of revenge that failed ultimately. Is that fair?
I think that's definitely fair. I mean, we've seen kind of Bob Iger even chronicle this in his autobiography, The Ride of a Lifetime, kind of dealing with a very difficult personality like Ike Perlmutter. They always had kind of their creative differences. Bob was forced to keep him on after the Marvel acquisition. That turned out to be a huge, huge win for Iger and for Disney. The Marvel movies bringing in billions and billions of dollars at the box office. But he had to constantly kind of contend with, Perlmutter's temper tantrums. Remember, Perlmutter wanted to get rid of Kevin Feige, and Kevin Feige has kind of been the whole creative genius behind Marvel and so many of the Disney movies. So it's been a very rough and rocky road, between the Disney management team as well as Ike Perlmutter. Of course, he was forced out. And, the way that Iger and kind of the Disney team have spun it is this has been kind of this vendetta against Disney by Ike Perlmutter. So I think there's definitely a ring of truth to that.
No matter how we got here, the company has been benefiting from some of what was suggested by Trian. And, we've seen the stock price advance. You mentioned that. I'm not sure about the succession planning. That's still out there. And it leaves us with the streaming strategy is something that we probably should discuss. How might the streaming strategy change from here, and how might it improve?
Yes, I don't necessarily think that Trian or Peltz offered any constructive advice when it came to any of the strategic visions around Disney. Yes, they're absolutely right that the succession plan has been botched and botched multiple times. And that is something that I think, they're obviously going to try and fix and do a good job. They have a whole committee just looking into succession right now. James Gorman from Morgan Stanley is kind of leading those efforts. So I think they'll definitely do their best there. From a streaming perspective, profitability, of course, is the big metric now. It's no longer subscribers. They have multiple levers, I think, in place to drive streaming profits. They're going to increase prices. They're going to make sure that they have the best content. They're not going to spend money like how they were spending. Everybody was spending money like drunken sailors. Everybody's now rationalizing output. They're rationalizing costs. And they're having many other different initiatives. They have a new ad tier. They're integrating Hulu and Disney Plus, and that's going to save them a whole bunch of costs. And then remember, they are going to crack down on password sharing a la Netflix. So all of this is going to, add to that bottom line.
Geetha, in a moment, I want to get your take on this Paramount Global deal with Shari, Redstone, and Skydance. We can talk about that in a moment. Obviously, Paramount is a company with legacy assets like CBS and MTV. And to get back to Disney, Disney is still holding on to ABC. Do you have a sense of what Disney is going to do with the network?
I think Disney, so there's been a lot of on-again, off-again speculation about what they want to do with their TV networks. Iger famously last year said that, everything is on the table. Maybe we don't really want to hold on to our TV assets. And then he kind of walked it back. And I think he realized that, yes, the TV assets are in secular decline. But at the same token, they do bring in a fair amount of cash. And they are they're going to be instrumental for him kind of crafting a digital strategy as well, which is exactly what he's doing with ESPN. Remember, he's again putting a lot of the linear TV networks into this new sports app that they're creating, and ABC is going to be part of that as well. Comes out a little bit later this year, along with Warner Brothers Discovery and Fox. So they have that in the works. They have the new ESPN digital strategy in the works. So I think they're really kind of trying to orchestrate this transition from linear to digital in as painless and as smooth a way as possible.
And just that one other area that we had raised a few moments ago, Succession, what's the latest there?
So they do have their 4 internal candidates who are all seen as possible successors. Again, remember, each of these candidates, whether it's from Parks or from the film division or the TV division or even ESPN, they all have specialized expertise. The problem for, the Disney succession plan is that you need somebody who has not just specialized expertise, but also broad expertise. And that's really going to be the challenge here. So I think they're going to have to have multiple successors, kind of groom them and see who really kind of is up for the challenge.
So let's get to Paramount Global, because we had some breaking news late in New York today. Shari Redstone, apparently with a tentative deal to sell her stake in Paramount Global. She is the controlling interest in National Amusements, and National has about 77% of voting shares for Paramount. Skydance Media looks to be the buyer. What's your take on this?
Again, this has been going on now for almost 4 or 5 months. So they've been engaged in some kind of discussions with really all different types of buyers. Of course, Skydance has been the one that's been there from the very beginning. Remember, Skydance Media is this film studio that is controlled by David Ellison, who is the son of Larry Ellison. And Skydance has had a lot of, collaboration with Paramount in the past. They almost have this 10-year relationship. They worked on movies together like, Top Gun Maverick. So there has been, a lot of exchange from on both sides. And so they feel like, it would be kind of the perfect fit. And I think in many ways, Shari Redstone wants to deal with Skydance because, again, this is, a known devil better than an unknown angel kind of a thing.
Mm.
So does this sort of signal the exit of Shari Redstone ultimately?
It's still going to be very, very complex and very messy. She does have, as you pointed out, a close to 80% voting interest, about a 10% economic interest. We're not yet clear exactly what Skydance has offered her for both, her economic stake as well as her, controlling voting stake in the company. So all of that has to be worked out. And then at the end of, all of this, the ultimate goal is that Skydance has not just to control National Amusements, but then has to somehow get complete control of Paramount. So it's kind of this very, very messy, complex two-step process.
Geetha, thanks so much for joining us. That's Bloomberg Intelligence's Geetha Ranganathan.
Let's take a closer look at what's going on in markets at the moment with our own Mark Cranfield. He is Bloomberg's MLIV Strategist. He joins us from our studios in Singapore. Hard to believe at the end of last year, the market was looking at 150 basis points in cuts from the Fed in calendar 24. I mean, that was super aggressive, well beyond double, in fact, what the Fed was predicting. And here we are now wondering whether we're going to get one rate cut. What the heck is going on here, Mark?
Well, what you can really see here is a disconnect between Jerome Powell and the rest of the Federal Reserve to some extent. So back in late November, early December, Jerome Powell appeared to be really optimistic that the Fed was on the path, that the inflation was going to hit its targets, everything was going to go right, and there'll be early rate cuts. And then the data came in and set everybody back. And you've heard a whole variety of Federal Reserve speakers who push back against the idea that not only 3 interest rate cuts is too many, but maybe we only need 1 this year, as you were saying. Mr. Bostic is the clear front runner in the one case.
I don't really worry too much about this kind of stuff because to me, the economy is leading, really. The Fed, it was talking about possibly doing more rate cuts, but it stipulated 3 in the coming year. And even no matter what they're saying, they're saying that they will follow the economy. They will be waiting on the data. And if you think about it, normally we think of the Fed leading, but the Fed is really following, and the market's not really leading either. The market is also following the economy. The economy is surprising all of us.
Well, they've said before that they're data dependent. Finally, it looks as though investors are believing it, having lost money by being too aggressive on the rate cuts in the first place. They're finally concluded that, okay, maybe we really should watch the data and react accordingly to that. But obviously different asset classes are viewing this in different ways. So the bond market is getting used to the idea that it's in a bit of a trading range, not really going anywhere for the time being. And yet the equity market is in a much stronger position where it knows that interest rate cuts are coming eventually. It's very confident that interest rates won't go up again. So that's much more important. And earnings are in a good situation. The underlying economy is doing very well. So all of that is favorable for the US economy. And the US dollar is fairly firm as well, which again helps as well. So different asset classes will respond in different ways. But the bond market for now is going to have to get used to probably sideways trading for quite a while yet.
You were talking about the dollar there. Yeah, we pulled back a little bit in New York trading. We weakened against the majors. But I think that to the tune that we were singing at the end of last year with much lower interest rates, I think guys in the foreign exchange really had to reverse their bets that we're going to see a great deal of dollar weakness. That hasn't happened so far this year. But when you look at some of the important crosses, and I'm thinking particularly dollar-yen, Brian was referencing a commentary from a former member of the BOJ board talking about the fact that now the heavy lifting has been done at the March meeting where we've moved away from the massive stimulus program on the part of what the Bank of Japan had been doing. Maybe there's no longer an urgent need to adjust further. Would you say that's a fair statement? I mean, are we going to see maybe stasis from the Bank of Japan?
I suspect they have more interest rate hikes to come this year from the Bank of Japan. But in terms of the US dollar, next week is probably going to be a pretty big moment for the dollar. If we get past non-farm payrolls at the end of this week and dollar yen still hasn't risen above 152, it may well be that it will just start the beginning of a downtrend for the dollar because people will lose patience. There are very, very big short positions against the yen, which have also prompted strong dollar positions elsewhere. If people don't see satisfaction quickly in achieving what they want in a strong dollar, they will go the other way. They will start cutting those positions and they'll look for the next trend. So it's a very big time coming up for the dollar.
Yeah, I think a lot of investors would look forward to that dollar weakening a little. Another currency besides the yen that's been weak against the greenback is the Chinese yuan. So let's switch the discussion to China briefly. Doug sent me a story which is quite interesting. Ray Dalio says he's sticking with China. What do you think, Mark? Is that a political call or is that a smart business and finance call?
I think if you're a good equity picker and you're looking at China onshore, you're bound to be able to find ways to invest and to make decent returns, because the Chinese government all the measures it's doing are to support Chinese-based companies to improve the Chinese economy. So most likely there will be decent returns to be found among good companies in China itself. The tricky part for a lot of investors is the Hong Kong side of it, because a lot of people like to use Hong Kong as a way to play China. That might be much more complicated because of the way in which the H shares are very cheap compared to the onshore, and they may stay that way for a long time.
Yeah, the big numbers in the week ahead for China will be the inflation numbers. And one of the things I think for the market right now is whether or not we're going to see a prolonged period of deflation in the mainland economy. Mark, it's always a pleasure. Thanks for making time to chat with us. From the Lion City, it's Mark Cranfield, Bloomberg MLIV Strategist.
Well, let's take a look at markets now with Belita Ong, chairman at Dalton Investments. Belita, thanks very much for joining you. I want to start with Jay Powell, and I want to play a clip from his speech a little bit earlier and then get your response to it. Powell did note the pickup in jobs and inflation, but he reaffirmed that the Fed wants to stay patient and watch the data. And while perhaps not intending to, Powell laid out the bull's base case.
But these recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path.
So the point is that he makes the point, sort of the bull's point, which is, look, don't overthink this. Things are pretty good. The economy is doing well. Profits have been increasing, and inflation is coming down, while acknowledging that it did pop up a little bit in January and February. Do you support that view, or do you think he's all wet?
I think Powell's right on track. It's very much the case that the U.S. economy is strong and that we have seen substantial improvement in the inflation numbers. My only caution is that I believe it's much harder to get it much further down than where it is currently, because we live in a world where there are hot wars going on and other unforeseen events that could disrupt supply chains. So you've got that to worry about. And that's, in recent memory, and even further back from that, but in recent memory, we've already seen the disruption in the Red Sea. And then we've also seen, the impact going further back 2 years or so of Russia's invasion on the grain market. So with these tensions running so high, it's difficult to be truly confident that the U.S. inflation numbers are insulated from, adverse surprises. But the point that he makes, I think, is that the economy is strong. And so there seems to be no hurry whatsoever to ease at this point. Why stoke an economy that's already strong and increase the odds that inflation will resurge?
I'm listening to you and I'm wondering whether or not there are people around the globe that feel the same way, and that's one reason to favor the U.S. Brian has been talking a lot about how well the market's been holding up as being kind of a response to the performance of the overall American economy. I get that. I don't disagree. But I'm wondering, given everything that you just laid out in terms of uncertainty and risk, whether you want to kind of be defensive and put, risk assets to work only in the United States, maybe at the expense of other markets. Is that a fair statement? And maybe Japan, you would include Japan in that.
I would definitely include Japan. Japan is cheap, and Japan is at a point in time where many things are going right, and it looks like it's about to take off. So Japan spent the last 9 years working on corporate governance reform. We're finally seeing the results of that through companies giving back returns to shareholders, either through dividends or share buybacks. Also, we're seeing an increase in unsolicited bids for companies, which is very unusual in Japan. And I can't remember when the first one was, but it was just no more than, say, 2-3 years ago. And the pressure from the TSE is quite heavy on managements to respond responsibly to these takeover bids. In the past, it wasn't uncommon to just simply ignore them. But now there is a list, if you like, of companies that are doing the right thing according to TSE reforms. And that includes being responsible in terms of taking seriously bids from investors or other companies to buy your company at a much higher price. So these events and the encouragement of the TSE is really propelling valuations upward. So even though we've just seen finally a new high in Japan after the 1989 peak and then collapse, it's taken 34 years, is it, to get back there. And we've just surpassed 40,000 on the Nikkei. And I think even better days are ahead.
Yeah, it's great to be diversified, and Japan's offering U.S. investors, for instance, great opportunities. Europe has done pretty well, too. The AI companies involved in that have rallied a lot, and just here in the last, say, 3 or 4 months, we've seen a lot of catch-up being done by cyclical-oriented companies, and so industrials and materials and financials have rallied pretty well. And the other thing that's kind of great about the environment is that you can make some bets on equities, which are obviously more risky assets, all the while collecting a 5% coupon on the bonds that you hold. And that wasn't always the case. You were forced into the equity market because you were getting nothing on bond yields, 1% or so. And that remains the case in Japan. So, I'm curious how you are sort of diversified big picture.
So we are, frankly, we're not particularly bullish about the U.S. simply because the valuations are so high. Being value investors, we invest one company at a time. And, for us, it's easier to focus on companies in Asia because they are a lot cheaper. So they provide you a margin of safety. So in addition to Japan, there are other parts of Asia that we think are quite attractive. One of them, clearly being India. And Indian valuations are not cheap, even by U.S. standards. But the growth of earnings among Indian companies is extremely high. I was looking at a recent table that showed that the earnings growth is something like 2.5 times that in the U.S. So if that's the case, surely you would want to accord a higher multiple to that growth in earnings. And then also, if you look at some other countries, like Korea, for instance, where you have fantastic companies. And the problem with Korea, what's been called the Korean discount, is one of governance. They've been so poor in terms of treating minority shareholders, fairly. That we've come to a point where the Korean government sees what's happened in Japan, that's successful, this long period of corporate governance reform, and they want to do the same thing in Korea because they have the same exact problems, which is an aging population and not enough returns on their stock market. Mm-hmm. So I think there are, good opportunities in Korea as well.
Belita, before we let you go, 30 seconds on China. Yes or no?
Not for us. China's cheap, but it's a difficult place for us because we don't see entrepreneurs taking care of minority shareholders.
All right, Belita, thanks very much for your insights. Belita Ong, chairman of Dalton Investments.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.